Hey guys, Whitney here. Thanks so much for joining me today. I am pleased to be joined by three very special guests. But before we get into that, and obviously you guys can see who they are, so they probably need no introduction. But I just wanted to, give you a little sneak peek that this is a new webinar series that we're launching, Passive Investing Made Simple. And this is going to be a weekly webinar series where we help you demystify the biggest myths that investors have around passive investing. Also, we'll dive into some of the terms, the math, just the things that can help you avoid making costly mistakes when passively investing, and then how to put all this knowledge into action and actually make your first or next investment. And just so you guys are connected to the entire series, be sure to go to, I'll dump the link into the chat here in just a second, but be sure that you are registered at masterclass.passiveinvesting.com/registration to see all the future sessions. And if you are ready to dive in and start seeing our deal flow, make sure that you go to passiveinvestingwithwhitney.com to get on that list and set up a time to talk with me. As you know, you guys are not here for me, you are here for you. So let's dive into this first episode. And in the series, I am so proud to be kicking this off with the three founders, the managing partners of passiveinvesting.com, Dan Handford, Randazzo, and Brandon Abbott. Thanks so much for joining me today, guys.
Glad to be here, Whitney. Really appreciate it.
Yeah. Well, before we start talking about passiveinvesting.com, I wanted to take a step back and dive into each of your personal stories around real estate, your journey. So I'm going to pitch this question out there and we'll see who raises their hand to answer first. How did you get started in real estate and why? Why real estate?
Well, I'll tell you, Brandon between the three of us likes to talk the most. So I'm going to volunteer Brandon to kick us off and get started, and then we'll go from there.
Brandon, looks like you're up.
Say that, but look who jumped in first. So yeah, my background was always in construction. Coming up out of high school, I moved to South Carolina from upstate New York. Got into construction, really just, framing houses, very entry level. I was just a teenager at the time, but grew through that industry and went into, eventually building houses and being a general contractor on my own, fast forward many, many years. And I went through the housing crash of 2008. And during that time period, or slightly before that time period, I was recognizing some other, possible income streams through either self-storage or, at that time, my mindset was a little bit smaller, but maybe some duplexes or some rentals, some rental income. And then we went through the housing crash and I firsthand experienced the loss of cash flow due to all of my contracts no longer being able to be fulfilled in the single family market because nobody was lending money. And so I had all these liabilities and no cash flow. And, that is not a good story or a good mix. And so at that time, really the light bulb went off as far as the power of rental income and streams of income from other individuals, because as people were losing their homes and homes were being foreclosed on, people have to live somewhere. And a lot of people moved out of their homes and moved into apartments. And so that kind of just awakened me to that sector a little bit more. And then fast forward another 8-10 years or so. I can't remember exactly how far it was. So I had that epiphany. Dan and I moved down to Columbia, South Carolina. Dan and I were going to the same church. We were going to take a trip. He wanted to go up to take his wife to New York City, to Manhattan. And he asked one of our assistant pastors if he wanted to go and his wife and who else he thought he should take. And they mentioned us. And so we got on the plane, and this is probably where Dan gets this idea that I like to talk a lot, because I didn't like to fly at the time. And so in order to compensate for my fear of flying, I would talk. So I talked nonstop, and Dan was explaining him getting into multifamily to offset some of the tax burden and, the cash flows. And so you combine that, what he's saying and his research that he'd done with my background and understanding it. And all the light bulbs were just going off. Actually, they were flashing, if you will, like, why am I not doing this? And and that sort of thing. And then got home from that trip. It was a great trip. We enjoyed ourselves. Got back from that trip and downloaded all the content I could for weeks on end. I did a lot of driving in that time for my job, and learned as much as I could. Went back to Dan and asked if he wanted to do something together. And that's really my foray into real estate at the level we're at now. I've always been involved in some sort, either building or developing or insurance adjusting or something along those lines. But that's my basic high level story.
Awesome. That's amazing. So we have a little bit of insight on how you and Dan met. Danny, let's kind of kick it to you. Like, what is your background in real estate?
So my background in real estate, I had always had an entrepreneurial spirit. So I won't go too far back into the history books, but I really started hustling to earn income doing side jobs, probably at the age of 7, 8, 9. I've written a couple of children's books just about the early lessons of counting money, keeping track of your money. And that kind of led me to Rich Dad, Poor Dad, which I still have the copy today. I have my dad's copy because his name was written in the top of the book of Rich Dad, Poor Dad. But I read that in high school and it always stuck with me. I came from a background where your parents were encouraging you to get good grades, go to college, get a good degree, get a good job at a company with some sort of pension or 401k plan. And so I got distracted in college, but I got good grades. I got out of college, started working for a large national global consulting firm, getting some great experience from a professional standpoint, getting some great experience from a personal standpoint, traveling around the world, working with multi-billion-dollar companies to help improve their financial performance. So very complementary skill set to really what I do from financials with our company. But when I got started, I was traveling about 250 nights away from home on average for many years. And so I got started initially by buying my first house in the Bay Area in San Francisco. So out in the East Bay, over by Oakland, California, and I started to house hack that. I had a 3-bedroom, 3.5-bath townhome that I was never home at. I had an upstairs bedroom that I just kind of locked and left. And then I had one renter who rented the downstairs unit from me. And I said, hey, this cash flow is great. And I rented the second bedroom and saw those tenants maybe on a couple times a year basis when I was home. And that was the spirit that really got me jump started into it. I studied a lot about the Bay Area and how to get into real estate, but the cost of entry is fairly high in terms of price per unit or returns compared to some of the Southeast US markets that we invest in now. And so my girlfriend at the time, my wife today, we had a conversation at the dinner table in Livermore, California for about 1 hour and decided right then that we were going to sell everything and move to Charleston, South Carolina. So we did that, which was, one of the best decisions we've ever made, and started to invest personally in real estate. So the first investment that we made was a $1 million office building. It was a triple net lease purchase. We took all of our own hard-earned money. We put about $100,000 down to buy that, and we were generating awesome cash flow, which is what we were looking for at that time, and slowly started to do a couple more deals and kind of did them one at a time. So we bought that first building to kind of prove the concept, to show that we we're invested in it. We're legitimate. We're taking this very seriously. And then we did a second deal. And for that one, I brought in a couple of really good friends that had known me for 20 plus years to invest alongside of us. And we always put our own money into each deal that we did all the way back then. And then I like to say that I've pretty much invested in every type of real estate asset class that there is. We've bought foreclosures from the tax sale. We have flipped properties. We have small 4-unit properties. We had beachfront rentals. We had Airbnbs. We had commercial triple net lease properties. And I started to learn that scalability was really, really important if you are going to make a business out of it. Having single family rentals, you can certainly do it and have a great quality of life. There's a difference that you have to juggle between ROI, return on investment, and ROT, return on time. And so with these smaller assets, it can be a good ROI, but it's also a very bad ROT. And so I started to learn that and knew that we had to scale up in terms of size. And multifamily, we had a couple of smaller properties in the multifamily space. And I knew that going larger was a lot more scalable. You're able to operate a 100-unit property under one kind of roof much more effectively and efficiently than 100 single family houses across an MSA or across a few states. And so that led me down the path of getting into multifamily. And Dan and I connected through a mutual mentor that we work with, and kind of started to learn the multifamily investing strategies and business plans through that mentor, and that kind of got the conversation rolling. And we looked at one deal together, the three of us, and eventually got one. And then we did a second one, and then we did a third one. And collectively, as a team of 3 partners here, we have great complementary skill sets, and as well as personal interests. We like to do different things within the business, and that's what's really allowed us to be effective and really grow to where we are today. Again, doing it one deal at a time.
Awesome. Thanks so much for sharing. And I can totally identify with the need to figure out how to scale from single family homes into multifamily, whether you're on the active side or the passive side. And I want to, kind of stick a pin in that concept real fast. But Dan, tell us how you guys, you have a unique background as well. Tell us how you got into real estate.
Well, before I get started with that, I know some of you are probably looking behind me and seeing all this video equipment and everything. I'll tell you the story behind that real quick. So my wife is the basketball coach for the local private school that our kids go to. None of our kids are in the basketball program just yet, but my wife is the coach. And so in order to, allow her to have the most opportunity for success, she asked me to video the games. So last night we had a game. And so I was downloading all the data into our software so we can do the stats and stuff like that. So that's what's going on behind me. But I know we didn't really touch on family too much, but I live here in Columbia, South Carolina. Brandon lives here, not with me, but in the same town with us. And married with my wife, and we have 4 children. 3 girls and a boy, and also a dog named Bella, little standard poodle. Our kids' ages are 11 years old, 9 years old, 5 years old, and 3 years old. The boy is the 9-year-old. So, but the way I got started in the business is really kind of goes back to my entrepreneur kind of background of owning multiple businesses. So I'm a chiropractor by trade. So I was trained as a chiropractor, but even before going into chiropractic school, I had my own business where I was doing web hosting, web design, networking, those types of things for computer technology, business, things like that. And went into chiropractic. When I first got into chiropractic, I had learned really quickly that I could only see so many patients within a given period of time. And so I was capping my income. And at the same time, I felt like I was in a job, even though I owned my own practice, because I could not go on vacation without not seeing, without losing revenue. Because if I wasn't there manually in the rooms adjusting the patients, I couldn't get any revenue in, and I couldn't stop paying my staff and the utilities and things like that. So I never really wanted to take a vacation because I would lose money going on vacation. And so I started trying to figure out ways to be able to duplicate myself, and first started off kind of hiring associate chiropractors to work underneath me, and then merged that business, or kind of converted that business to what's called a MD-DC clinic, where we had medical doctors as well as chiropractors working together under the same roof. And then I really fell into a niche of medicine called non-surgical orthopedics and sports medicine. And about 5 or 6 years ago, we completely removed the chiropractic services from the clinics that we have. And we actually have 4 clinics today, one here in Columbia, South Carolina. We have one down in Charleston, South Carolina, near Danny. And we have one in Greenville, South Carolina, and then over in North Augusta, South Carolina. And we have about 40 employees that work inside of that group. And I have a good CEO who runs that and manages it and things like that. But what we did is when we kind of grew that business from a single clinic to multiple clinics, and kind of scaled down the offerings to just the service that I was really passionate about, which is the non-surgical orthopedics, because there's just not a lot of options there for people who are kind of one step before surgery. And instead of just managing their pain the rest of their life, we're trying to figure out and uncover the underlying problem with their condition, and trying to put treatment plans in place to avoid surgery, and also avoid the kind of pain management life, if you will, for the rest of their life. And so that's kind of what we do in our clinics. But with these clinics, my wife and I poured our heart and our life and our soul into these things, and constantly just poured money back into the business to grow them, to the point where once we had these 4 clinics up and running, we had a lot of cash flow coming in, and we were paying a lot of money in cash to the government every single year. And for any of you who own a business, you kind of know what I'm talking about. But it's not, they don't just hit you in business once a year at the end. They try to go, okay, we're gonna make you think about this paying every single quarter, right? And got to make those quarterly payments. And so that's what we were doing, is making these large 6-figure quarterly payments. And it was rather disheartening and kind of frustrating to work all year long and have to pay every quarter into the government system there. And so we were trying to find ways to offset that income. And so real estate really was that ticket. And so I started doing some investing myself on the LP side first, to kind of learn the ropes, kind of figure out what it was like to be an LP investor. Then I started to go into the active space, and the mutual mentor that Danny was talking about earlier, he helped me kind of get to where we are today. And that's kind of how, Dan, and that's kind of how Brandon and I kind of got connected, is, me being in the space, doing some passive investing, teaching him a little bit about it, him learning about it, and us getting together. And then of course, Danny shortly thereafter coming along and coming together was pretty, it was a great timing, if you will, because like Danny said, we all have complementary skill sets. And in order for a partnership to work, and if I know many of you on here have probably been a part of a partnership before, or know of partnerships that just didn't work out, they've kind of failed. And it's something that I was very cognizant of, and all 3 of us were from the very beginning, because all 3 of us had been in situations where partnerships didn't work out. And we wanted to make sure that this partnership could be a successful partnership. And so one of the keys to the success of a partnership is making sure that you have partners that have complementary skill sets, instead of everybody just being the same, right? And that's one of the reasons why we've been so successful, is that we each one of us have our own separate lanes that we really, not that we just like to do, we really enjoy it. Like, we get up in the mornings and think about it, and just can't wait to get into it, right? Like me, I really enjoy the investor relations piece, and talking to investors, and coming up with ways to kind of make sure that we can take care and protect our investors. And then of course, Brandon going in and talking to brokers and building out the team there, and also working with the construction management side, and really, developing relationships with these brokers, and allow us to acquire a good quality properties. And of course, Danny, he's the one I'll never understand, because I have never woke up I've never woke up wanting to look at a spreadsheet, right? But I think he wakes up in the middle of a dream of a spreadsheet, right? And that's how much he enjoys the finance side of what we do. And so I think that's one of the biggest things for us is about as to why we work so well together. And I think it's been it's shown in the proof that we've been able to have with our successful exits of our properties, but also how our investors talk about us with other investors about our communication level and our ability to execute on the business plans. But that's a little bit about my background. I know we're going to get into a few other things, Whitney, so I don't want to steal your show at all here. So I'll turn it back over to you and let you take it from here.
No, this is wonderful because I think, it's so easy, talking to investors, they get so enamored by the markets and the deals. And really, whenever a passive investor is coming to an organization, I really try to help them understand that it is the team. You have to flip from actually looking at, especially if you have invested in small multifamily or small single family properties, it's not the deal that is successful, it's the team that makes the deal successful. So I really appreciate you guys taking the time and just giving us a little bit of insight into each of your journeys that brought everybody together here at passiveinvesting.com. So I wanted to pivot a little bit. What would you say is the core investment philosophy at passiveinvesting.com? I really want to help the audience understand what sets our core investment philosophy apart from other groups.
I'll let Danny take this one. I'll put him on the spot here.
So our core philosophy and really what we believe in as investors ourselves, because again, we invest in every single deal that we put out there. So it has to be a good investment that we put our personal money into, is to, number one, be conservative with the investments. We are not trying to make 1,000% returns in very short timeframes. These are long-term hold investments. These are conservative by nature. And our philosophy is to buy in a great location where there are economic, demographic details that support that market, from a population growth, from a job growth, from an average household income perspective, where those economic indicators give us a very good possibility to meet our business plan and ideally exceed our conservative business plan. And so I call it kind of like the 15 minutes to Whole Food rule of thumb. So if you think about where Whole Foods is at, those areas are going to typically have the best schools. They're going to have good job demographics. There's going to be diversified employer demographic bases. So you are buying and investing in an area where there's many employers. So if one employer goes away, your resident base is still going to be diversified so other folks can pay their rent if you have one or two residents out of 200 units that may have lost their job because one employer went away. It's not going to be a blip on the radar when you have 200 units and your occupancy is 90+%, which leads me to my second point about property criteria that we look for. So not only are we looking for the best schools, the best markets, the best locations, we're looking for very well built, very well maintained properties that attract a very good resident diversification. So we like to see residents who have well over 3 times monthly income compared to rent. Again, basic investment principles that give us that possibility to meet and ideally exceed our business plan. And so that's kind of the high levels of specific investment criteria and philosophy of what we look for. Having those specific requirements when we make our investments, it's allowed us to have very, very good outcomes. And what we learned even through COVID, as we think back, for the last year and a half or so, 2 years, is that these great locations, these very nice, well-built properties performed the best. And then even as we think back to 2008, during, one of the worst financial crises that we've seen, again, these nicer, higher quality, great located properties performed very well, where the occupancy remained pretty stable at 90+% occupancy, with, again, most of the residents being able to pay rent on time. You may have 1 or 2% of residents who had challenges with their jobs and whatnot, but from an overall perspective, we have a great possibility to meet and exceed the business plan that we put forth. And so that's really what we look for in an investment. And I'm getting some snickers in the background. I see smiling faces. If
Danny's
I
all
went
about
into
the
too much
numbers.
Detail, please let me know.
I mean, there's also what we consider, we've talked about it as kind of like the buddy test or the friend test. Is like, if you have a friend visiting in town and you're touring them around town and you drive by one of your investment assets, are you proud to show them, hey, look, we own this, we are invested in this? Or you're like, hey, look over there, this is kind of really bad, so that's a short way of saying what Danny is saying, the A-class nice assets, because is it a place where I would live, on the multifamily side, or is it a place where I would store my stuff if it's on the self-storage side? So those are things that we kind of just a quick self-test, as well as the location, like Dan said, with the Whole Foods. But I'm definitely more on the asset side. The prettier it is, the easier it is for people to understand the attractiveness of it and why you're able to achieve higher rents.
Awesome.
And I was going to say one more thing in here, Whitney, is, you kind of have to look at the risk profile of the different asset classes as well, right? So if you look at both sides of the spectrum of asset classes, you have the kind of really, really expensive high-end Class A's. We would call them kind of the downtown urban infill Class A's. Those are on one side of the spectrum. And on the other side of the spectrum is actually the lower end assets. So it's those kind of Class C assets. Those are the highest risk assets that you have out there. The very high end Class A's and the kind of very low end assets in the Class C's. Those are the highest risk. Now, both of them also provide the highest level of return, but again, there's the risk reward ratio there as well. Well, we prefer to stay in kind of a more conservative spot, which is kind of that A-class, suburban A-class, as well as kind of a nicer B+ asset. So those are the types of assets that we go after, is that a higher end B-class asset and that A-class asset, because it provides a lot of risk adjusted returns, and also some diversification for those that might be heavily weighted in some of these higher risk investments, whether it's that downtown urban infill or that Class C, or the third level, probably the highest risk of all of them is new development, right? The new development is probably the highest risk of all the different classes, because it's not even online yet. They don't even know if those units are going to be able to be absorbed or not, based on that particular market. Hopefully they've done their feasibility study to determine whether or not that's actually going to work or not. But that's a big thing that you have to understand. And there's a lot of people in this space, when they're looking to invest, that get some misinformation from other kind of coaches or conferences that they go to that say, stay away from A-class, only go into the kind of lower end B and C class assets, because that's where all the money is made. And if you look at, if they basically say, and if you have a recession, it's great because all the A's go to B and the B's go to C, and the C's, I don't know where they go. They probably don't go anywhere, but they just sit there, right? But what they're primarily looking at is only the physical occupancy of a property. And what you have to really think about and understand about these assets is that there's two different types of occupancy. There's the physical occupancy of a property, and then there's the economic occupancy of the property. And so to kind of break both of those down real quick, the physical occupancy is I have 100 units available and I have 95 people occupying those units. I have a 95% physical occupancy. But that doesn't mean I have 95 people actually paying for the rent on those units. I might only have 85 of those units actually paying. So now my economic occupancy is 85%. And so you really have to look at that very closely. And we actually did some research before we made this jump in the last several years to be only in this kind of class A and higher end B plus asset. We looked at the numbers just to determine, was that actually true? Do all the A's go to B and B's go to C and yada, yada? And if you go, and we actually subscribe to a software called CoStar. And so we looked at the data for all the way back to 2001, I believe is what the data goes back to, but really specifically focused on the 08 crash to kind of figure out what happened there. And if you look across the board, across all the assets, there was about a 30 to 50 basis drop in occupancy across the board. So it wasn't specific to like, oh, all of a sudden A's dropped down to 50%. You know, there was still they still maintained that occupancy. The two assets that got hit the worst from an economic occupancy perspective was actually the higher end class A's and those downtown urban infills where the rents were $5,000, $6,000, $7,000, $8,000 a month. And then the lower end assets, because on the lower end assets, those people are the ones that are going to be losing their jobs the most. The more service kind of blue collar workers. And even though you might have a high physical occupancy, the economic occupancy on those properties takes a hit. And you also have a higher turnover. So now your expenses go up because you're having to turn over people after you've evicted them due to non-payment, if you're able to in that particular market. Obviously with COVID, we were handcuffed even more as landlords from what we could actually do. But then those kind of higher end A-class people, then what do? They usually still pay, but they actually will drop down into the suburban class A's. You're not going to have a high-end class A person paying $8,000 a month go down to a class C. It just doesn't make any sense, right? You're actually at that point, you're changing not only the asset class, but now you're changing the overall demographic or socioeconomic class of that particular resident. And it just doesn't happen. And you can just think about this logically, how that doesn't actually happen. You don't have them jump from that far down the scale. They're going to go, okay, instead of living downtown, having this convenient lifestyle, paying this $8,000 a month, I'm just going to move to the suburban area a little bit and be 20 minutes away and pay, $1,500 or $2,000 a month and still have these nice amenities that I get from some of these downtown assets.
Thank you so much for drawing that, drawing that conclusion for us, because that is something that, in conversations with people that, I spend quite a bit of time to help them tease out. There's a difference in A, like it's not just one bucket for A. Like there's the luxury downtown infill, then there's the more suburban, class A. And as far as like an investment philosophy, I think, when we're targeting more of those, upper Bs and into the As, part of what we're stabilizing the property, and the property comes stabilized, but which gives us cash flow pretty much right off the bat. And then, when we work our magic with our business plan, then we were able to add some additional streams of income to push the NOI of the asset and, pull those appreciation levers. And so thank you for helping draw that, that delineation between those two different types of A's. Now, Brandon, you already kind of touched on, Danny's like,
the last thing I was going to add is just the math that goes along with thinking about,
this is the spreadsheets, guys. I'm telling you,
class A piece.
He's thinking about the numbers again.
I'm so glad to have somebody like this, on the team.
The way I think about the class A product is we've bought class A deals where the average rent is $1,500 a month. And when you think about what type of resident can afford to qualify from an income perspective, 1,500 times 3 times income for a monthly rent payment is $4,500, times by 12 is $54,000 in annual income. So that to me gives perspective of class A is actually affordable for a lot of people when you're looking at that kind of 15-minute radius to Whole Foods, where the average household income is $100,000. On average, anyone who lives there could move in and afford to pay that $1,500 per month rent. And so it is class A, but it's very affordable for the average individual.
No, thank you. Thank you. So pivoting a little bit, now that you guys are, we've touched a little bit on, Brandon's, friend test, and then also like the Whole Foods kind of 15 minutes around whole food, that gives us a little bit of grounding on what type of markets we're looking at, but can we get a little bit more specific of where in the United States we're looking?
Yeah, so we're targeting obviously the Southeast region. The reason for the targeting of the Southeast region, and when I say Southeast, it's pretty much I would say from Tennessee down and then over to Texas. We do have specific states and cities within that for specific reasons, but that's where the population growth is. That's where it has been for many years. It's also where we have the most landlord-friendly laws. There are great assets in some of I'm from New York, so some of the northern states, but the landlord laws are not conducive to a good business model and can leave you open to some collection issues and cap your rental premiums. So we like the Southeast for that reason. We just are always watching population movement. You can track different stats, like as far as where different U-Haul trucks are moving to, and different stats along those lines, different job locations. A lot of people with COVID, after COVID, are now able to work remotely. We're also seeing a shift from, this goes along with what we were saying before, from the heavy urban and the high rise and even some of the mid rise to more of a suburban product, because they don't have to live so close to work now. And so we've seen a lot
and
of
get more square footage.
Right. They can expand out a little bit. They can maybe live on the beach if they want. We've seen the coastal markets blow up quite a bit. A lot of the West Coast tech employees are able to keep that West Coast salary and live in the Southeast with a much lower cost of living. And so they can afford a much nicer place, but they're more want to get out, spread their legs a little bit out in the suburban markets. And we've seen that shift across the board. Specifically, I would say, South Carolina, North Carolina, Florida, Georgia, Texas, Arizona are kind of our main focuses right now, as far as states are concerned. Anything you'd like to add, Danny? I see you got your wheels are spinning.
I'll hold.
Awesome. So I've been keeping an eye on the chat, and we had somebody write in about the exit strategy, and that was a question that I had on here because this has been such a hot year for appreciation in all parts of the real estate market, and we've seen we've actually had some exits here at Passive Investing as well. So can you guys just touch on just broad strokes what the hold strategy is and the exit strategy is?
When we first put the business plan together, we, typically plan for that longer term hold. There are unique scenarios where we are presented with opportunities to sell early. So the most important thing in real estate is being able to hold an asset, as in generate enough income to pay all of your expenses, and sell when the market is most advantageous to do so. And so that's really why we need to stay nimble and kind of always questioning, when do we sell? How long do we hold this asset, and do that on a quarterly, semi-annual, and annual basis, just to make sure we're making the best decision for the investment. So when a unique opportunity presents itself to exit early, what we have to weigh is the ability to generate a return on investment. Also, what is the possibility to reinvest or give investors an opportunity to 1031 if they choose to or not, to minimize any tax burden, which is a great advantage. When you think about in today's market, if you were able to buy something, I'm going to use a very small example, $100,000 property. Let's say you bought it all cash and it is now worth $200,000 today. And you had a renter paying you, I'm going to say 10% return annually for their rent. if you're making 10% return on $100,000, you're making 10 grand a year, versus if you had $200,000 and you were able to go and place that into a new property and make 10% return, now you're making 20 grand. And so you're able to take that equity that you've created and put all of that equity to work instead of having half of your money working for you. So that's one advantage. The other advantage with multifamily, as everyone has begun to grow and like the depreciation, depreciation trails off each year as you own the property. So year one is your largest depreciation year. Year two is slightly less than year one. Year three is slightly less than year two, and so on and so forth. It's a scale that goes down like this. So highest at the first, and then it trails off pretty quickly by the time you get to that fifth year. And so that's an advantage of selling early, taking the maximum depreciation from your sold asset, being able to 1031 if you choose to into a new asset, and getting all of your equity working for you to create that return and have another opportunity to get some more accelerated depreciation, and as well as having that new asset perform and ideally have that kind of value add component or appreciation opportunity in the new asset as well.
That's amazing. Yeah, I actually have 6 assets that are repositioning right now at the end of the year, 5 of which I can go through a 1031 exchange. A good bulk of those are here at passiveinvesting.com. So I'm super excited about that, because that, when if the 1031 exchange is the right choice, right? You have to first check that box. This is the right choice for you as an investor. Now you're amplifying your returns on the next investment. So thanks for taking the time to explain that. Now, guys, we can go down the rabbit hole on so many things, but I wanted to just kind of ask one big kind of catch-all question here before we wrap up. And what is the one biggest takeaway that you want listeners to get from our time together here today?
I would say one of the biggest things that I think that for me, that I know from our investors that I have lots of conversations with, that kind of sets us apart from other operators that, you might be familiar with in the space, is that investors really enjoy working with us because we spend a lot of time focusing on how can we improve the current operations that we have right now to effectively communicate better with investors, and also be able to present things in a way that's understandable to investors, and be as transparent and as possible to our investors. And I would say, if you've followed us for any length or any period of time, you have probably seen that we do investor dinners around the country. We don't have to do these dinners. We don't have to have phone calls with our investors at this point, but we enjoy having these types of interactions with our investors because we want our investors to have that relationship with us. When we talk about investor relations, we take the relation part very seriously. And I think having these investor dinners definitely helps. But I bring that up because this year, I think we've done probably close to maybe 15 or 20 of these investor dinners across the country. And at every single one of them, the number one thing that we ask is, what is, not the one thing we ask, but one of the things that we ask is, what is it that you like about our group, and why do you continue to invest with us? Because usually at these events, we'll have events that will have like half the room that has actually invested with us multiple times, and the other half of the room has never invested with us. And so we like to be able to get both of those groups of people in the same room together, because it's great to have investors talk like that and just be real around a nice kind of meal and to have a fellowship time. And one of the number one responses, or the number one response that we get at every one of those investor dinners, is the communication that comes out of our group. And we work very hard to make sure that we can effectively communicate. And I'll say we're not perfect, but I would say that we constantly try to strive to have the best communication. And for most investors, it's the communication is really the main component of making sure that their investment is performing well, which is why we do monthly updates, which is why we do these investor dinners, which is why when we're kind of doing our education, even these types of things like this, we try to make sure that we can open up that line of communication as much as we can. And every offering that we have ever put out, in the front of that offering, we always put my cell phone number, Danny's cell phone number, Brandon's cell phone number, our personal emails, so that our investors can reach out to us. So if they have questions, they can access us. Obviously, we have our team that's behind us that, they can obviously ask them as well, but they know that if there is something that they really want to reach out to us about, they have that ability, they have that lifeline, and they can reach out to us. And I would say, I know this is kind of a long answer to your question, Whitney, but I would say that communication out of our group is something that is very high on our list. And we strive to make sure that we can communicate to our investors in the best way possible. And every single week where we're communicating within the team about how can we communicate better amongst our investors as well.
Awesome. Thank you. Yes. All right, guys, I know we're kind of approaching time, and I wanted to leave a little bit of time for people to jump over into the chat box and take the opportunity to fire off some questions. We'll see how many we can get through, but while people are formulating their questions and dropping those into the chat box so we can ask you guys live, I wanted to pick your brain personally on a couple of things that I think might provide value to the listeners here. And let's do a little bit around the room. What is your number one best piece of investing advice?
I'll take that one. So we were actually meeting with some investors. Dan and I were meeting with some investors today, and they made the comment of the best time to plant a tree is 5 years ago. And so the number one piece of advice would be to start as soon as possible. I had the epiphany about cash flows and rental properties multiple years ago, but didn't take action. So an idea is just an idea until you take action on it. And so I wish I'd started sooner, with the tax benefits and the multiple streams of cash flow that real estate can provide. So that's my one.
Awesome. Dan, Danny, do you guys have your best piece of investing advice?
My best piece of advice is to make sure that the investment, whatever it is, fits your goal. So if you are looking for, monthly cash flow that's consistent, multifamily investing is a great way to go compared to the stock market, which may not provide consistent cash flow, or a single family rental, which if you have one hot water heater that breaks, that may ruin your cash flow for a year or two. So I think it's very, very important for each individual investor to think about what their goal is and make sure that that investment type fits their need, because there's a variety of investments out there. And, everyone is in a different individual position. So it's just important that that investment meets your need. And if we can provide that, great. If we can't provide that, I'm sure we can, point you in the right direction to find something that will.
And one of the thing that I would mention is, as far as kind of my best advice is, make sure that when you're looking at different opportunities that are out there, that you vet the team, you vet the operator, and you look for specific things that would make you say, no, I shouldn't invest with this. And my wife and I, we actually have been investing, and we have right now, I think we're right at about maybe 56, 57 different LP investments with about 17 different operators around the country. And we actually put together an article of like the 7 red flags to look for. And so for those of you who are joining live, I just was looking this up while Daniel was talking. Here's a link to the article that we wrote that talks about those 7 red flags. So you can review those things and use this as a tool and a resource when you're looking at various different offerings that are out there. And it says it's specific to apartment investing, just the red flags for passive apartment investing. But these same red flags are applicable to not just apartments, but even to self-storage and hotels and triple net and other types of commercial, industrial, medical office buildings, whatever you may have there. But and for those of you who are watching the recording on here, obviously I can't give you a link via recording, but if you just go to our website, passiveinvesting.com, in the top right-hand corner somewhere, there's a link there that says Knowledge Center. If you click on Knowledge Center and in the search box, just type in red flags, it'll be the first article that'll show up in that list of articles. So that would be my parting advice, is to review these red flags and make sure that when you vet other operations and offerings that you review this red flag list, because literally these are not just red flags that we just came up with. Like literally, if we see this if one of these red flags are present, they're not yellow flags for us. These are red flags, meaning flags that tell us stop wasting your time, move on to the next one, right? Yellow flags are the ones where you go, maybe I should just consider that and make sure I know that and understand it, but know that moving forward. No, it's to us, it's a red flag. It means stop doing it. Don't move forward with that investment.
Awesome. Well, thank you guys so much for your time today. It has been such a pleasure. And just to recap for everybody, if you are, well, obviously if you're here, you guys are already on the registration list. If you are watching this via recording, make sure you go to masterclass.passiveinvesting.com/registration to get on future, or get the notice about future episodes, and also get those recordings. And if you want to hop on it, if you want to talk to me directly, jump on passiveinvestingwithwhitney.com. We'll get you connected there. And we look forward to seeing you next week. We're going to tackle some tax questions. Everybody's number one topic. They love taxes. Absolutely. But guys, thank you so much for joining me today. It's been such a pleasure. And we will see you guys soon.